The over-the-counter Forex market, the OTC Forex market for short, is a decentralized market where currency pairs are traded directly between banks, financial institutions, brokers, and individual traders. Unlike stock exchanges, there is no physical location or central exchange. Transactions occur electronically through a network of banks and brokers. Now, let's look at the key participants in the OTC Forex market. First, we have the banks. Major international banks are the largest participants, providing liquidity to the market. They trade large volumes of currencies for various purposes, including hedging, speculation, and facilitating international business. Next, there are central banks. Central banks manage currency reserves and implement monetary policies. Their interventions can significantly influence currency prices. Other participants are financial institutions. Hedge funds, pension funds, and investment managers participate in the Forex market for investment purposes and to manage their portfolios. Lastly, there are brokers that facilitate trades for retail and institutional clients, while dealers trade on their own accounts, often providing liquidity to the market. Moving on, let's explore the different types of securities that are traded in the OTC market. This market includes a variety of securities. Here are some examples. For instance, equities traded over the counter often come from smaller companies that can't afford the listing fees of major exchanges. These include common and preferred shares of companies that don't meet the stringent requirements of traditional exchanges. Bonds are typically marketed through broker-dealer networks by banks, making them part of the OTC market. Each bond can have unique terms, issuers, and credit ratings. OTC derivatives include customized contracts such as forwards, futures, swaps, and exotic options. These are privately negotiated through brokers and derive their value from underlying assets like stocks, commodities, or currencies. ADRs are certificates issued by U.S. banks representing shares in foreign companies, allowing U.S. investors to trade foreign stocks more easily on American markets. Currencies are traded on the Forex market, which operates over the counter. Forex trading occurs 24 hours a day across a global network of banks, brokers, and financial institutions. Lastly, digital currencies like Bitcoin and Ethereum are traded OTC through various online platforms, providing a decentralized method for trading these digital assets. Shifting our focus, let's discuss the tiers of OTC markets. OTC markets can be categorized into three main tiers based on regulatory oversight and the type of securities traded. Starting with OTC QX, this is the highest tier with stringent listing requirements. Companies here are typically well established and meet high financial standards. Next, we have OTC QB, known as the venture market. This tier includes developing companies that still meet specific reporting standards, but with less stringent requirements than OTC QX. Lastly, OTC Pink, also known as the Pink Sheets, has no formal listing requirements. It includes a wide variety of companies, many of which may not provide regular financial disclosures, making it the riskiest tier. Now, let's discuss the pros and cons of the OTC market. Starting with the advantages, OTC markets provide significant accessibility, offering a wider range of securities, including those from smaller companies not listed on major exchanges. They also offer flexibility, with non-standardized transaction sizes, allowing for more tailored investment strategies. Another benefit is the extended trading hours, which mean that trading can occur at any time, providing opportunities to react to global events and market changes. Lower costs are another advantage, as OTC markets avoid the high fees associated with listing on major exchanges, potentially lowering transaction costs. Finally, OTC markets offer greater privacy for transactions, which is beneficial for large institutional trades not wanting visibility. On the downside, OTC markets face several challenges. There is a lack of transparency compared to regulated exchanges, making information about securities harder to obtain and increasing the risk of misinformation. Liquidity risks are also higher, as lower trading volumes for many OTC securities can make it harder to buy or sell without affecting prices. There is a higher risk of fraud due to less regulatory oversight, increasing the risk of encountering fraudulent or unreliable securities. Pricing inefficiency is another issue, with less competition and fewer participants leading to wider bid-ask spreads and less favorable pricing. Lastly, regulatory variability can be a problem, as inconsistent regulatory oversight can result in varying levels of investor protection and stability. Lastly, let's discuss the regulatory environment. Regulation of the OTC Forex market varies by country, with major financial centers having specific regulatory bodies overseeing the activities of brokers and financial institutions. In the United States, the Commodity Futures Trading Commission and the National Futures Association regulate forex trading. In the United Kingdom, the Financial Conduct Authority is responsible for overseeing forex trading activities. Within the European Union, the European Securities and Markets Authority provides guidelines and regulations for forex trading. In Australia, the Australian Securities and Investments Commission regulates forex trading. I hope this overview has clarified some aspects of the forex OTC market for you. Make sure to watch our next video where we'll take an in-depth look at the role of forex brokers.